ready to play a little golf? Well, ClubCorp hopes so. They are going public, and they're hoping to raise over $300 million. Joining me is Francis Gaskins. He's the Director of Research at Equities.com. Francis, golf courses, private country clubs, that just doesn't sound like a growth business to me. I can't imagine why this company is going public and not, coming out as maybe a REIT.
Well, it doesn't have the cash flow for that. It's a private equity deal, and it's a roll-up of golf clubs and country clubs and fitness centers. And top-line revenue is only growing 4 to 5% a year in the last couple of years in the 6 months ending June. So that's probably because of price increases. And the market totally loves growth. And if a company doesn't have growth and doesn't have profits, it's not very interesting. So this is just a deal. They're paying on their debt, they're paying 10%, which is quite a bit in today's market. So you're using the proceeds basically to pay down their debt. And if you do a pro forma, that will get them to a modest profit position. And the only growth they have in earnings is if they raise more money and pay down more debt, I think.
I think that some may look at this and say, well, it's an asset play because they do own the land of 80 of the 102 golf courses. And yes, the land could be valuable, but that's only if they're able to, eventually monetize it, and then that means the club goes away.
Right. Yeah. That's the underlying pitch, to investors. But then their top line revenue goes away. So it's just a way to get liquidity for the private investors that finance the roll up of all these country clubs.
All right. Well, it sounds like if you are interested in taking shares of ClubCorp, you might be better off just going there to play golf and not buy the company stock.